especially for the DeFi channel. So today we're going to demystify the world of cryptocurrency. I know, it's a topic that can feel super intimidating, right? Like there's this huge barrier to entry. But we've put this guide together specifically for absolute beginners. We're going to start from square one, the very beginning. So yeah, let's dive right in.
Okay, so to really get a handle on cryptocurrency, we've got to take a step back and talk about money itself. Yep. See, crypto wasn't just some random invention that popped out of nowhere. You could almost say it was inevitable, a response to a really, really old problem. So let's kick things off with a pretty fundamental question.
Well, the answer really lies in this idea called the degradation of money. It's not something that happened overnight. We're talking about a historical process that's been quietly chugging along for centuries, and it has completely changed the game, fundamentally altering what we even use as money and what we think is valuable in the first place. So if you look at this timeline, you start to see a really clear pattern, right? We started out with money made from stuff that was actually valuable on its own, mainly because it was rare, like gold. But then, over time, governments started introducing less valuable metals, like copper. After that, we got paper money, which at first was backed by gold, but eventually that connection was cut. And that brings us to today, to what we call fiat currency. It only has value because a government says it does. And here's the kicker. They can print as much of it as they want without any limit. And that, of course, is what leads to inflation and eats away at the value of your savings. And then, right in the middle of the fallout from the 2008 global financial crisis, in January 2009, something totally new appeared. A person, or maybe a group of people, we don't know, using the name Satoshi Nakamoto published a paper on this small online forum. And in it, they announced the creation of the world's very first cryptocurrency, Bitcoin. And the crazy part? To this day, nobody has any idea who Satoshi really is. So Bitcoin was specifically engineered to solve that exact problem of unlimited money printing. Its core idea is actually pretty simple, but it's incredibly powerful. A fixed, unchangeable supply. Only 21 million will ever exist, period. Think about it like gold. It's hard to get out of the ground, right? Well, new Bitcoins are designed to get progressively harder and harder to mine over time. This built-in programmed scarcity is exactly why people call it digital gold. It's basically bringing back the idea of a limited resource to how we think about money. But wait a second. This brings up a huge question, doesn't it? I mean, how can something that's just digital code actually be rare? What stops someone from just, copying and pasting it a million times? Well, the answer is a truly revolutionary piece of technology that underpins not just Bitcoin, but pretty much the entire crypto universe, and it's called the blockchain. So think of it like this. Let's say you and two of your friends keep a shared journal to track all your money transfers between each other. Now, what if one person tries to write down that they received $1,000 when they really only got 100? Well, the other two can just look back at the previous pages and see that the numbers don't add up. The whole thing gets rejected. A blockchain is pretty much this exact same idea, just playing out on a massive, global digital scale. All right, so here's a super simplified look at how this whole thing works. Step 1, you decide you want to send some crypto to someone. That request gets broadcast out to a huge global network of computers. We call these computers miners. Now, all of these miners start competing. They're all racing to solve a really complex math problem. It's basically a cryptographic puzzle. Solving this puzzle is what validates your transaction. The very first miner to crack it gets to add your transaction along with others to a new block on the chain. And here's the magic. This new block is cryptographically locked to the one before it, creating this permanent, unchangeable public record. And for all that hard work, the miner who won the race gets rewarded with brand new crypto. And that, my friends, is what we call mining.
Okay, so now that we've got the basics down, it's super important to realize that not all crypto systems are made the same, not even close. For the most part, they fall into two very different categories. And trust me, understanding this difference is absolutely critical if you want to navigate this space safely.
All right, let's break down the two sides. On one hand, you've got decentralized systems, like Bitcoin or Ethereum. You could say these are the pure or ideal form of crypto. They're public, nobody owns or controls them, and you, and only you, have full control of your money. But that freedom comes with a price. Transactions can be slower, and the fees can get pretty high when the network is busy. On the other hand, you have centralized systems, like the big exchanges you hear about, like Binance. They offer lightning-fast transactions and super low fees. So what's the catch? Well, it's a big one. You're basically trusting a company with your money. You don't truly own the keys. So if that company gets hacked or goes bankrupt, poof, your funds could be gone forever. You're essentially trading control for convenience. This really shows you just how diverse the whole crypto world is. It's not just one thing. So, first up, you've got your standalone blockchains, like Bitcoin. It has its own coin, and that's it. Then you have platform blockchains, and the big one here is Ethereum. Think of it like an operating system, like Windows or iOS, but for crypto. It has its own coin, but it also lets thousands of other projects build on top of it. The coins built on these platforms, we call those tokens. And finally, you've got a really interesting category, stablecoins. These are coins specifically designed to always be worth $1. Their whole purpose is to give you stability and a way to escape the wild price swings you see with other cryptos. All right, so you're ready to get some crypto. But where do you keep it? Well, you can't just stick it in your normal bank account. Nope, you need a special kind of digital wallet. This isn't just for storing your crypto. More importantly, it's what proves you actually own it. And there are basically two main types of wallets you need to know about. First, you've got hot wallets. These are just software, like an app on your phone or a program on your computer. Because they're always connected to the internet, they're super convenient for frequent trading and everyday use. Then you have cold wallets. These are actual physical hardware devices, kind of like a specialized USB stick. They're kept completely offline. This makes them the absolute most secure way to store your crypto for the long term. Think of it like your own personal, high-security vault. So let's walk through creating a wallet. We'll use Trust Wallet as an example. It's pretty popular. First, you just download the app from your app store. Easy enough. You'll open it up and select Create a New Wallet. And then you will get to the single most important step in your entire crypto journey. I'm not exaggerating. The app is going to show you 12 secret words. This is what's called your seed phrase, and it is everything. It is the master key to all of your funds. You absolutely have to write these 12 words down on a piece of paper and hide them somewhere safe. And when I say safe, I mean offline. Do not take a screenshot. Do not save it in a text file on your computer. Write it down physically. Look, I really can't stress this enough. Your 12-word seed phrase is your key. No phrase, no crypto. It's that simple. If you lose your phone, no big deal. You can just use those 12 words to get your wallet back on a new device. But if you lose those 12 words, your money is gone. Forever. There's no one to call, there's no customer support hotline, there's absolutely no forgot my password button to click. In the world of decentralized crypto, you are your own bank, and that means you and you alone are responsible for keeping your keys safe. Okay, so once you're actually in the market, you're going to realize pretty quickly that it has its own unique language and its own cast of characters. People often describe them using animal analogies, so to navigate this space, you kind of need to understand the crypto zoo. And let's be honest, we all start out as the hamster. A hamster is basically an inexperienced trader who makes all their decisions based on pure emotion, panic, and greed. They see a coin's price shooting up and they buy in because of greed. Then they see the price start to dip and they immediately sell out of panic. The goal for everyone is to learn and evolve beyond this stage. You want to learn the fundamentals so you can stop being the hamster and start making calm, rational decisions. Next up, you have the two big forces that drive the market, bears and bulls. It's pretty simple. Bears are the traders who think the market is going to go down. They're pessimistic and they try to profit from falling prices, waiting patiently for a good, low entry point. Bulls, on the other hand, are the optimists. They believe the market is headed up, and they profit from those rising prices. Now, a really skilled trader doesn't just pick a team and stick with it. They know how to be both, adapting their strategy depending on whether we're in a bear market or a bull market. And finally, you have the whale. A whale is a really, really big player. We're talking about an individual or an institution with so much capital, so much crypto, that a single trade they make can actually influence the entire market. When a whale makes a big move, it creates waves for everyone else. That's why a common strategy for smaller traders is to just watch what the whales are doing very, very closely. And all of this brings us to our last, and honestly probably the most important topic for any beginner. There's a saying, in crypto, it's much easier to lose money than to make it. And you really need to remember that. Yeah, it's true, people can make fortunes, but what you don't hear about as much is that money is lost way more easily and way more often. The risks here are absolutely extreme. You know, the beginner's greatest enemy, the single biggest risk you're going to face, it's not some complicated chart. It's not even a big market crash. Nope. It's a simple, incredibly powerful, and really destructive emotion that lives right inside your own head. I'm talking about FOMO, the fear of missing out. You know that feeling, right? That overwhelming anxiety when you see a coin just skyrocketing in price and everyone on social media is posting about how rich they're getting. You get this intense, urgent feeling that you have to buy in right now or you're going to miss out on a life-changing opportunity. This is a psychological trap, plain and simple. Acting on FOMO almost always means you end up buying at the absolute worst possible time, right at the peak, just moments before the early investors decide it's time to cash out and take their profits. Learning how to recognize this feeling, and more importantly, how to control it, that is the single most critical skill for surviving and maybe even succeeding in the wild world of crypto. That's all. Subscribe so you don't miss anything. And if you want more, all the links are in the description.